Is the market going to tank if Biden wins? What happens if we have a blue wave? Do I need to make changes to my investments before the election? Hi, I'm Brian Hughes, a financial advisor with River City Wealth Management.
And I'm Michelle Barron, also a financial advisor with River City Wealth Management. Those are some great questions, Brian, and they are the questions that are on everyone's mind. It's amazing to me, as I meet with clients, that tends to be the number one question. Now think about this. Some clients I haven't seen since before COVID. We've had a major market downturn this year in February and March, and then a pretty good comeback since then. But most don't even want to focus on that. Overwhelmingly, the number one question that I'm asked are what are our investment plans for the upcoming election?
Right, so let's just step back and first quickly talk about where this election is. We're recording this today on October 5th, and after we talk about that, we'll jump into what it means for investors and what we think investors should be doing. So we learned in 2016 that we really shouldn't trust polling, and we learned we shouldn't trust polling when Trump is involved. Whatever the reason, whether it's because people don't have and answer landlines anymore, or pollsters can't quite get the demographics right, and so on, the polls are not perfect. And so we're going to take any poll numbers with a grain of salt, but that said, I still do watch the poll numbers. And so right now, looking at averages of the different polls compiled by Real Clear Politics, Biden does lead. But there's a few important notes to that. Trump has narrowed that gap somewhat. On July 1st, Biden was leading by 9.4 points in the national averages. On October 2nd, that gap was down to 6.8 points, though following this last weekend in Trump's COVID diagnosis, that gap did go back to an 8.3 lead for Biden. The other important note is that the national average doesn't matter that much because of our electoral system, where it's really a race to 270 electoral votes. The numbers in the battleground states matter more. So Wisconsin, Michigan, Pennsylvania, North Carolina, Florida, Arizona, in those battleground states, the gap is even narrower, averaging just a 3.8 point lead for Biden, which in my mind is getting really close to that toss-up type range.
So Brian and I are financial advisors, so we follow markets closely and the market indicators closely. You'll likely hear all sorts of market predictors about the election, but they all have the same thing. Fair or unfair, the economy matters in election cycles. Generally, a good economy means the incumbent party gets reelected. For example, according to Ned Davis research, since 1952, there have been 6 times where there was either a recession or a 20% decline in the market during the election year. Now, the incumbent party won 0 of those 6 elections. The point here being that 2020, we have had both a recession and a 20% market decline. The economic indicators point towards Biden. The question is this year different? Is this year's recession that was caused by the pandemic different than previous times? Do voters place the blame of a recession on Trump and his actions, or do they overlook the downturn from earlier this year and focus on what looks like to be a pretty nice path to recovery?
Yeah, and the headlines are usually about the presidential election, but don't overlook the House and Senate races. They are equally as important, and really, in this election cycle, it's about the Senate. In the House, it's highly likely that the House is going to remain under Democrat control.
Right. Control of the Senate looks pretty close. Basing it again off Real Clear Politics, there are 8 toss-up elections. Out of those 8 toss-up seats, 7 of them are held by Republicans. For the GOP to keep its majority in the Senate, it needs to win all of the seats that they are likely favored to win, and it needs to win 5 of those 8 toss-ups to hold a simple 51-seat majority. According to the polling that we have to take with a big grain of salt, Real Clear Politics has Republicans trailing in 5 of those 8 toss-up seats. Republicans need to play some defense here in order to keep its majority. Now, the Senate race is really important because it will impact the ability for either candidate to implement his agenda. I can say that right now, I don't really know how this election plays out, and nobody does. I don't trust the polls, and I don't trust the market indicators because of the uniqueness of this year. But I do think overall things are a toss-up of either 4 more years of the status quo, a Biden win with a Republican Senate, or a blue wave. And it's that blue wave scenario and that blue agenda that some people are worried about, especially as it relates to the markets and their investments.
Right, and especially under the blue wave, the general sense that I get is that investors are primarily worried about tax increases with maybe a nod to increased regulation. So Biden's agenda does include tax increases on businesses and higher income individuals. To briefly run down some of the highlights, if Biden actually got his agenda completely implemented, which is why that Senate race is important, folks making over $400,000 would see their taxes go up by an inclusion of the 12.4% Social Security payroll taxes on wages over $400,000. And that kind of creates this awkward donut hole where you pay Social Security taxes on wages up to $137,700, then no Social Security taxes on wages between $137,700 to $400,000, then Social Security taxes again on anything over $400,000. Now the tax rate for those over $400,000 would also increase from 37% to 39.6%. Step up in capital gains for anyone inheriting appreciated assets, not just high income earners, would also potentially be eliminated, which would really dramatically change planning in our world. And taxes on long-term gains and qualified dividends will be taxed at ordinary income for earners making over $1 million. Now, the target obviously for Biden is high earners. On the corporate side, the highlight is that income tax would increase from 28% from the 21% that Trump got it down to, and there would be a minimum corporate tax that's aimed at all those companies we hear about that take advantage of these tax loopholes to drive their taxes way down. That minimum tax will limit their ability to take advantage of those loopholes. Now, the tax proposals, especially on the corporate side of things, are not market friendly. Let's take a look at this chart.
We can't take credit for this. It's actually produced by Natixis. Natixis is an investment company that has fund families like Loomis and Oakmark under their umbrella. This chart tries to estimate what the increase in taxes would do to company earnings, and obviously when you have more taxes that you have to pay, you end up with less net earnings at the end of the day. Now, on the whole, they estimate the S&P 500 earnings to be hit around 8.5% to 9%. But looking at it on the sector level, you see some areas are hit harder than others, like communications and tech, who were big beneficiaries of the Trump tax cuts. Again, this is just an estimate and one firm's estimate. Another firm we follow, Ned Davis Research, has the hit to earnings at about 12.7%. Obviously, with these being estimates, we don't know exactly how the increases will impact earners, and we don't know what would actually be able to get passed. But we can say that Biden is not going to be as tax-friendly if he wins as Trump has been, and that is negative for markets. With that said, we can't keep our head in a bubble. I don't believe everything under a Biden win is going to be bad for the markets. Now, don't get me wrong, I don't agree with big government and big government spending, but I do believe the markets love government spending. Look at the stimulus package earlier this year. It certainly helped the market rebound from the COVID-sparked recession. While it has been a drawn-out battle, Congress is in negotiations for a new stimulus package to help the economy. If Democrats get their way, we'll be spending $2.4 trillion. Republicans are proposing a package at the $1 trillion level. Either way, it's a lot of market stimulus.
Yeah, and there's been some proposals to try to split it down the middle, but obviously $1.4 trillion is a big difference in spending. And citing another difference, Biden's proposing a $2 trillion infrastructure spending package. Trump's plan is closer to $1 trillion. So again, I'm not a fan of bigger spending when our debt is so large. It's got to be paid for sometime, and I think this debt hurts in the long run, but bigger government spending does help the economy right now. So I'm going to put up another slide again from Natixis where they try to estimate the change in earnings for the S&P 500 based on taxes, and then makes adjustments for things that help the market under Biden, which is the infrastructure spending that Michelle just talked about, as well as de-escalation of some of the trade wars, mainly with China. And as you can see on the left half of the chart, earnings are hurt by the increase in the corporate tax rate, changes to the GILTI deduction, which is related to taxes on foreign earnings for corporations, and the minimum tax on corporation. That takes the consensus estimated 2021 earnings per share for the S&P 500 from 163 down to 149. And one thing I kind of feel gets forgotten a bit, before the coronavirus, a trade war and all the tariffs were dominating the headlines for years, it seems, and dominated the short-term moves in the market. I think it's important to protect property rights, and I believe in fair and open trade, but remember, tariffs are a tax to the economy and make things more expensive for consumers. For better or worse, I believe Biden likely will be a lot easier with other countries in matters of trade. New trade deals, reduced or eliminated tariffs, those are positives for the market in the short term. When Natixis estimates the potential positive short-term impacts of easier trade and increased infrastructure spending under Biden, in conjunction with the increased taxes, their 2021 S&P 500 earnings per share estimate goes from 163 to 158.5, or roughly a 3% decline in potential earnings next year.
The point is, we think a Biden win is negative for the markets, but probably not as bad as many people fear. And we still believe that the larger driver of the economy will continue to be related to the course of the pandemic, the pace of the medical advances to fight the pandemic, as well as the pace of getting back to normal, whatever normal is going to look like going forward. That doesn't mean the markets won't be volatile. In today's world, the slightest headline can cause big daily moves. And since I believe the markets perceive a Biden win will be negative for the markets, I think a Biden win will be bumpy initially, especially in a contested election situation. So what are investors to do? For every doom and gloom report, there is probably one with a completely different view. In fact, one of my clients recently turned me on to this site called The Flip Side. It tries to specifically go over both sides' points of view on each of the different issues. Now, don't fall victim to the headline news boom or bust type reporting. Remember that campaign agendas and proposals and what they can actually get passed are two entirely different things.
I believe that neither party can afford to risk derailing an economic recovery, which means that, in my opinion, the path of the virus impacts the extent that any policy can potentially be pushed through. In the long run, economic fundamentals, company earnings, GDP growth, interest rate, inflation, those types of things prevail in market prices over the long run. Don't trade on the fear and greed emotions that are following this election. Second, you have to ask, do you have a financial plan? A financial plan takes into account things like your goals, your financial picture, and it commits you to a target destination that you want to hit in the future. When you have a financial plan with a long-term strategy, it's easier to navigate times like these where there's just simply a ton of circumstances converging all at once. We believe investors come out ahead in the long run by emphasizing making changes in your portfolio or your investment strategy based in changes in your goals or changes in your financial situation, instead of making changes based off political conditions.
Finally, if you're worried about the election, worried about your financial plan, we want to help you through various markets and events to help build better investors in our community. We have a few free tools for you. We regularly write and post on our blog, Covering Your Assets, where we talk about financial topics and occasionally post videos like this. We will have more in the coming month about the election. We invite you to follow our Facebook page or visit our website and sign up for our monthly newsletter and blog updates. We do offer a free 1-hour consultation to anyone, either in person or virtually. So if you want to come on in, talk about your situation, get some direction, and learn more about what we do here, give our office a call. We'd love to hear from you. We'd like to get to know about you, and we appreciate you joining us today. Thank you. We'll see you next time.